Hey guys, my name is Mike Boyd, this is the Money Flare, and today we have to talk about what's been going on with the so-called meme stocks. People on Reddit are talking about it, people on YouTube are talking about it, and so I figured I'd like to cover what's going on as best as I can. I'm also seeing a lot of views out there that I don't necessarily agree with, so I figured that I should probably chime in on the whole conversation. So I don't think this whole meme stock social movement is a surprise to anyone watching this channel or who is actively following markets. It's been on the news ever since February when GameStop had its historic run. But for anyone not sure what I'm talking about, or if you'd like a bit of a refresher on exactly what's happening, let me go through the whole story. In February of this year, a little-known video game retail store by the name of GameStop took the markets and the world by storm. For many years before, the company wasn't doing so well as games went more and more digital, and the company's stock, GME, was on a steady decline ever since 2016. But in February of this year, all of that changed. A few positive catalysts and some genuine progress that the company was making set off what will probably go down in history as the most spectacular short squeeze in markets. The stock shot up 1,700% in a month and 18,000% since April 2020. A measly $1,000 investment would have grown to almost $188,000 at the peak. You see, what happened is what is known as a short squeeze. And back in February, it seemed as if everyone was Googling short squeeze and learning about it. But in case you're still confused, let me explain. You see, most people are familiar with the whole buy and hold strategy for stocks, where you ideally buy low and you sell high, making the bet that the price will be higher at some point in the future. But what if you believe a stock will be lower in the future? Well, what you can do is what is known as shorting a stock. It's also called short selling. When you short a stock, you're essentially borrowing a stock from your broker and selling it immediately on the market. In the process, you pocket the cash and are required to eventually buy back the stock that you shorted to close the position. And if the price is lower when you buy back, then you make that profit. It's the same idea as buying low and selling high, except in reverse, where the selling happens first and the buying last. And the entire time that you are shorting a stock, you pay a small borrowing fee. The key difference between buy and hold and short selling is the magnitude of potential losses. If you buy a stock, the most you can lose is the amount of money that you put in. Your risk is defined. But if you short a stock, the losses depend on how high the price rises. And if the price rises a lot, you could suffer extreme losses. GameStop was epically shorted by hedge funds. For many months, it was at the top of the list of the most shorted stocks in the market. And on January 23rd, GME's short interest, which is the percentage of shares shorted compared to the number of shares available for trading, that was at a whopping 138%. So that means that more shares were shorted than are available for trading. So the situation was very ripe for a juicy short squeeze. A short squeeze happens when people who are short a stock start to cover or close their positions by buying back the shares that they borrowed. But this buying activity causes the stock's price to rise further and potentially triggering more shorts to cover, who then buy back their shares, pushing the price even higher. Given the right conditions and the right catalyst, any highly shorted stock which sees a huge price rise can create this positive feedback loop and can cause prices to rise beyond anyone's wildest imagination. And it wasn't just GameStop that was squeezing either. We saw similar price spikes in things like BlackBerry and Nokia and AMC. Short squeezes have happened before in the past. In 2008, Volkswagen had a massive short squeeze, causing it to become, for a moment, the most valuable company in the world. These things happen in a free market, but the cause of this short squeeze is unique. At the core of the madness this time is a Reddit community called Wall Street Bets. And right now it's pretty famous, but it used to be a relatively small community where people would post about ridiculously risky stock bets, usually littered with memes. It's a place where Elon Musk is referred to as Papa Musk, and where self-identified degenerate gamblers YOLO their life savings on individual stocks to ride the Tendy rocket all the way to the moon. Members of the community like to refer to themselves as autists or apes, diamond hands and never selling is a virtue, and any pushback is memed and ridiculed, whether it's from the mainstream media or older boomer investors who patronize the community. A lot of these smaller retail traders have been the ones buying up these stocks, buying options, and causing these spectacular short squeezes. I've been following the subreddit for years, and I find it hilarious, and the events of this past year have been truly surprising to see. And what has been most surprising is that the drama didn't end in February. Most recently, highly shorted stocks have been vastly outperforming the market, suggesting that there's a second round of short squeezes occurring. This past week, Clover was up, GME was up, BlackBerry was up, and AMC in particular shot up like crazy. Without a doubt, this first started as simply a good trade, and part of the community was in it for the money and to make a quick buck. And that's still a major driving factor for those involved in these stocks. I'm not denying that greed is the primary motivation for some. But if that were the only motivation, then the current situation might not have gotten so explosive at times. Everyone sells at a certain price, and it would take something much more powerful than greed to compel someone not to sell a stock that's risen 1,000% in a week. The motivations are clear. It's to wage war against Wall Street and to cause as much pain as possible, no matter the costs. As cliche as it sounds, it's not really all about the money. Over the past few months, meme stocks like GameStop and AMC and BlackBerry, they've become a legitimate social movement among younger generations and among millennials who feel that they've inherited a truly unfair and corrupt financial system where the game is rigged. A system where younger generations own a smaller portion of wealth compared to what older generations had at that same age. I spoke about this sentiment in my crypto video, the whole situation of hopelessness and desperation and anger that's pushing many young people into things like crypto, in my opinion, is the same situation and sentiment that's fueling this whole meme stock movement. It's become a form of protest against the 1% and against hedge funds who many feel have been manipulating markets in their favor for a while with the help of mainstream financial media and with people and government taking part, all while regulators turned a blind eye. But unlike Bitcoin and crypto, whose ecosystems are centered on a legitimate new technological invention full of potential, this movement is much more nihilistic. Members of the community aren't buying these meme stocks because they actually think AMC is worth $50. They're buying them to show support for the movement. These stocks are essentially just tokens in the community, and so the price and valuations don't really matter. It's about sending a message and being part of something bigger than themselves, being part of a community who has each other's backs and who celebrate each other's losses just as much as the wins. And hopefully make money and get back at hedge funds and short sellers in the process. Many millennials don't have much wealth as it is, so with nothing to lose, why not bet on something like GameStop or AMC? I'm not here to defend the victim mentality, nor do I fully believe in the bleak picture that I just described. I'm merely acknowledging the very real feelings of hopelessness and nihilism that I see from a large part of society, and my generation in particular, including many people in the Wall Street Bets community. The meme stock situation is further proof that if the status quo continues, the people who feel left behind, betrayed, and without purpose in life will find ways to push back. In fact, many would say that it's time the little guys start beating hedge funds at their own game. And that's exactly what's been happening. These short squeezes have hit the hedge fund community hard. The losses back in February were as large as $20 billion. Most famously, it was reported that the hedge fund Melvin Capital was down 30% in January alone, in part due to their large GameStop short, and they needed a $2.8 billion bailout just to keep their doors open. And this past week, Citadel reportedly had a $3 billion loss mark to market due to their short positions in these meme stocks. And mark to market means that it's an unrealized loss, and so it could get worse if these stocks surge even higher. However, I have my own criticisms of the movement. As much as I love to see hedge funds get punished for making bad trades, I also see a lot of talk about short sellers that I fundamentally disagree with. I was watching a discussion the other day on YouTube about this whole topic with a group of personal finance YouTubers, and what struck me most was how unanimous the view was that short sellers are inherently crooked. They used the word dirty. People who short stocks are dirty and they deserve to be punished and targeted in this movement. Even Chamath Palihapitiya in an interview on CNBC said short selling is very un-American. Now let's get some things straight. Short sellers are not dirty and shorting a stock is not wrong. Anyone familiar with markets will tell you that shorts play a very important role in a healthy market. And so I don't think we should be rejoicing to see short sellers going out of business. They're already a dying breed in today's market. It's a very tough business to be in. And I also don't think we should be happy to see less shorting going on because, as I said, shorting serves a very important role in markets. Firstly, activist short sellers like Mark Cohodes or Carson Block or Jim Carruthers, they serve a very important function of exposing financial fraud. For example, it was a short seller that exposed Incest Therapeutics, whose founder was sentenced to prison for bribing doctors to prescribe and get patients hooked on their fentanyl-based pain medication, even when it was unnecessary. It was short sellers who exposed the Wirecard fraud, which was going on for a decade until they looked into the company more closely. Their stock quickly went to zero right after. Many criminals have ended up in prison due to the diligent work of activist short sellers, and so they serve such an important role in getting rid of these bad actors. Secondly, shorting is a necessary risk management tactic for active investors. That's where the word hedge in hedge fund originates. They hedge their stock positions by shorting stocks. It's completely normal and understandable from a risk management perspective. The alternative to shorting is reducing your long exposure, so that would be selling your positions, and during a crisis, that could cause markets to literally gap down as investors without any other way of reducing risk are forced to sell and rush to the exit all at once. This is especially dangerous for illiquid assets like credit, and this type of scenario would greatly increase the risk of a credit crisis, which would put the overall financial plumbing at risk. And finally, shorts make the market much less fragile because they act as the buyer of last resort. When markets are crashing, people who have shorted are many times the only ones buying back stocks in that environment as people rush to sell. They provide liquidity to the market when it needs it most. And so if people are unable or too scared to short, then historically it has made the market much more fragile and much more susceptible to sharp corrections and volatility. So I don't agree with the premise that shorting is bad. Of course, there are many bad actors who abuse and manipulate via shorting, but I think we have to be careful not to lump every short seller into that group. We should be careful not to throw the baby out with the bathwater. I also don't like how a lot of uninformed investors get dragged into this movement and into these trades at exactly the worst moments. It's sad to see people dumping their hard-earned cash into these meme stocks that have already gone up thousands of percentage points. Many retail investors end up chasing these trades, which is never profitable. They're usually the ones that end up buying at the top. So I think you have to be very careful in this respect and to understand that the market is not a casino and there's no easy money. Be prepared to lose if you're wrong. And my last criticism is the notion that it's the retail traders who are sticking it to the man in these meme stocks. All the evidence suggests that while it may have started out as a retail trade, many hedge funds piled in as well, and they added fuel to the fire. So while the movement claims to be about punishing the establishment, it's also enriching a lot of people in that establishment. Some hedge funds are losing big time, but a lot of others are profiting, usually at the expense of the retail trader who chases these trends. The market is also fully aware of this tactic by now, so when you're buying your next call option on AMC, understand that the market maker selling you that option is selling it to you at a much higher premium now. Market makers are smart, and so they're not just going to allow these types of short squeezes dominated by retail option buying. They will price that out of the market, and that might fizzle out this whole phenomenon, and we're actually already seeing that happen. Always remember that there is no such thing as easy money in the market. So I'm all for hedge funds being punished for making bad trades. They shouldn't be bailed out and they should learn their lesson, and the market is better off as a result. It weeds out the bad actors and only the strong survive. The whole concept of too big to fail has to stop in my opinion. The big firms making money at the expense of the little guy is just not right. Giving certain investors free rein to gamble and to take too much risk knowing that they'll just get bailed out because they're too big to fail, I think that's at the core of a lot of the problems fueling this movement. I think the most positive aspect of this whole situation is that it's an example of the benefits of the whole democratization of investing, which the internet and places like Reddit and online communities have allowed for. It used to be that only large institutions or wealthy individuals had access to the best investing info. But now all that can be found online, and the retail trader, the smaller investor, who was once considered dumb money, is proving that they're not that dumb anymore. Information barriers are no longer present, and now retail investors have access to high quality information and research about stocks and markets more than ever before. Spend enough time scrolling through the posts on Wall Street Bets and you'll come to realize that a lot of the people on there have pretty impressive financial market knowledge and in-depth analysis. Some have no clue what they're doing, but a lot know exactly the risks that they're taking. And no one can deny that at the very least, the community was smart enough to discover the opportunity in GameStop and a lot of these other highly shorted meme stocks. I wouldn't recommend anyone put a significant amount of money in a meme stock. Usually once they've pumped, it's already too late. And I don't see the benefit either of parking your money in one of these stocks and letting it sit there hoping that it'll eventually be the next short squeeze. But then again, I have no clue what will happen, and there's nothing wrong with having a very small percentage of your portfolio for speculation and making riskier bets. I just think that the market is catching on to this trend and there won't be this type of opportunity anymore. But I could be wrong. So it's anyone's guess how this war on Wall Street will end. While I may not agree with every part of the movement, I'm very sympathetic to the overall cause. At the very least, this movement is bringing some of the more sinister actions of certain hedge funds into the light. I also fully applaud those crazy gamblers in the Wall Street Bets community who have executed these trades flawlessly and who have become super rich as a result. Even the Mormon Church is making a profit on these stocks. It's rather poetic that a Reddit community of degenerate gamblers have become the rallying cry of this generation's version of class warfare, marching behind the banner of companies like GameStop, which many millennials grew up with and have fond memories of, and who feel much like the company itself, left behind and with no hope for a promising future. As I said before, I don't fully agree with the completely bleak picture that I described earlier about millennials. I think we should all play the game with the hand we've been dealt, and we should make the best of the situation that we inherit. But many would argue that that's exactly what people are doing with this whole movement. It's a logical response to the financial system that we've inherited. I can't predict what this may mean for the markets or the social fabric going forward. Until then, I'll enjoy the memes, watch markets carefully, and wish all the brave GME and AMC holders luck. Nina Simone once said that it's an artist's duty to reflect the times, and I can't think of a better way of reflecting these crazy times that we're living in than by enjoying this community's own form of artwork through memes. There's no better way to understand the culture of this movement. So I hope you enjoyed this last part of the video. Thank you guys as always for watching, and I'll see you at the next video.
There once was a stock that put to sea. The name of the stock was GME. The price blew up and the shorts dipped down. Hold my bully boys, hold. Soon may the tendy man come to send a rocket into the sun. One day when the trading is done, we'll take our gains and go. She had not been 2 weeks from shore when Ryan Cohen joined the board. The captain called all hands and swore he'll take his shares and hold. Soon may the tendy man come to send a rocket into the sun. One day when the trading is done, we'll take our gains and go. Before the news had hit the market, Wall Street bets came up and bought it with diamond hands. They knew they'd profit if they could only hold. Soon may the tendy man come to send a rocket into the sun. One day when the trading is done, we'll take our gains and go. No deals were cut, no shorts were squeezed. The captain's mind was not on greed, but he belonged to the artist's creed. He took the risk to hold.
Somewhere between 700 billion and a trillion, 300 million.
One day when the trading is done, we'll take our gains and go. For 40 days or even more, the stock went up, then down once more. All gains were lost, it was looking poor, but still those traders did hold. Soon may the tendy man come to send a rocket into the sun. One day when the trading is done, we'll take our gains and go. As far as I've heard, the fight's still on. The short's not squeezed and the gain's not won. The tendy man makes his regular call to encourage the captain, crew, and all. Soon may the tendy man come to send a rocket into the sun. One day when the trading is done, we'll take our gains and go. Soon may the tendy man come to send a rocket into the sun. One day when the trading is done, we'll take our gains and go.